doing that honors to them. Okay. Good evening, friends, or good morning, wherever you are. Welcome to this another episode of Finsherpa's Academy. We call it an academy primarily because I think there's a lot of learning that we hope to bring through this medium. And with your permission, I'd like to just kind of share the screen on a small presentation that I have on just about Finsherpa that I need to kind of play. So as I said, Finsherpa is an organization that's dedicated towards helping people plan their investments, financial planning, retirement planning, tax planning. We are based out of India, more specifically Chennai, but we cater to our investors across the world. So right through the pandemic, one of the things that we have been able to successfully do is to use the power of internet and specifically Zoom to kind of bring topics of interest to our investors and public at large. So we have done more than about 60 sessions in the last 2 years with a variety of different guests and speakers on topics right from women investors to global investing to Indian markets, everything relating to money. On a variety of different topics, we have brought experts to share their wisdom with us. So that's really what we believe in. Today is no different, friends. Now, one of the things that I have learned is that between 2000 and 2020, native Chinese, that is non-resident Chinese who have been successful in other parts of the world, have been among the largest investors in mainland China. In a variety of economic activity, they have been the largest investors. It's not portfolio money, but the Chinese who are repatriating money back to the base have been the largest investors, a couple of billions, maybe even trillions of dollars. So one of the things that did is that it helped the Chinese economy grow, but it also meant that some of these Chinese, expat Chinese, made a great return based on the growth that China saw over those 2 decades. My belief is that India is on the cusp of something very similar in terms of growth. And of course, we have problems. But is there a way to navigate through this kind of puzzling journey of, especially for NRIs, to invest in India? And that's really the question that most of us have in our minds. And who better to talk about this than Mr. Vishwanathan, a dear friend of ours, who has taken time to kind of talk to us about his own journey and his learnings out of that journey, or how he kind of started out investing. But before I pass on the baton to Mr. Vishwanathan, a brief background about him. Vishwanathan is a global executive for over 3 decades in successful business, mostly in US and Asia, in travel, hospitality, and information technology. He's currently the CEO of Anico Management Consultants, a strategy consulting boutique based in Dallas, USA, and Chennai, helping global clients in digital transformation, strategy, and execution. He's held senior positions across a variety of enterprises, chief among them being he was the CEO of Ubix, a NASDAQ-listed public limited company, a leader in strategic and integrated IT services headquartered in Pittsburgh. Vish has also been a senior advisor to UV Holdings, Asia Pacific. He's an elected board member at TAI. We all know TAI, the Indus Entrepreneur Group. He's been very active in the Chennai chapter. He's a member of the several startup companies in US and India, actively mentors young entrepreneurs. Vish is an accredited angel investor with the Chennai Angels in India, and a very active alumni of the Hindi Engineering and the Blue Tree Allied Angels in US. That's one side of Vish is also a very, very active social worker. He has been kind of literally these last 2 years spent time feeding the unfortunate underprivileged people out of this children's hospital in Egmore. That's one thing which I know and which he has spent time dearly. But he has spent time in other places as well. And Vish is a US citizen and overseas citizen of India, so holds a OCI card as well. So Vish has been there, done that. He's been in the US, has kind of moved to India, learned the investment journey along the way. So no better person than Vish Vishwanathan to talk to us about the journey of pros and cons of investing by NRIs. And with no more ado, please welcome Vish Vishwanathan. Over to you, sir.
Thank you, Babu. Good evening to and good morning to a lot of you. I think most of you are in the US. So I will start with that. What I'm going to do now is to do a quick presentation. Can you see my screen now?
Yes, we can see.
Okay.
So if you can just make it, yeah, that's great.
Is it okay?
Yeah, it's perfect.
All right. So I'm going to spend the first 20 minutes of the presentation with some slides that I put together on this topic. And then we're going to go on to the next 20 minutes where I think Babu has some questions that he wants to ask, which we will do in a chat mode. And then the last 20 minutes we'll use for question and answers. In between, if you guys want to ask any questions, I'm fine with that. I am very used to doing such presentations. In fact, I made a career out of making presentations. So this is something I do regularly. So if you guys want to stop me and ask questions, by all means, you can ask the question. As Babu said, that I've lived quite a long time in the U.S. Originally born in India, studied in India, moved to the U.S. for higher studies. Studied masters in industrial engineering, operations research, and business management in the U.S. Worked in the U.S. for several decades. Came back to India, set up organizations here, ran companies in the U.S. from here, as well as companies based in India. And in 2004, as a family, we made a decision to relocate back to India for good, for a variety of reasons. I am the only son for my parents, so I wanted to take care of my parents. So in 2004, we decided to relocate lock, stock, and barrel from the US to India. And my children were born in the US, who are US citizens by birth. They both studied here in India and studied all the way up to college. My older one is a medical doctor, and the younger one is a computer science engineer. And they both have now gone back to the US. So during this time, when I came back, a lot of my attention was spent on trying to figure out how to set up the shop back in India, whether it is for investments or for college or for real estate, etc. So back in 2003, there weren't very many people coming this direction. A lot of them are going towards the west, so there wasn't very much precedence, if you will, in terms of asking someone. So a lot of what I'm going to present today is based on my own experience going through the motions of investing in India. Okay, so with that, I will go to the slides. So the first disclaimer I want to put, normally I put in all the slides, is that I'm not a lawyer, I'm not a certified financial advisor or a tax professional. All I'm showing here is information that I have gained from my own experience. Also, any information, any statistics I quote are all publicly available information. And I'm doing this as a pro bono service. I do a lot of such webinars. In fact, I've done a couple of dozen such webinars targeted towards the NRI community in the US in terms of immigration, taxation, FEMA, in terms of angel investing, entrepreneurship, education, higher education in the US, settling back in India, retirement in India. I've done a whole variety of webinars I do regularly for people in the US. Most of them are targeted towards our alumni, our college alumni in the US. Sometimes other organizations also ask me to do such seminars. So if any of you are interested, you can reach out to me and I can set up a seminar if there are enough interest from people in your group. Okay. I'm happy to provide referral to the service providers that I use for my services in India. I don't get any referral fee from them, but after having done a lot of research and finding the right kind of investment advisors, I don't want everyone else to reinvent the same wheel. So if you wish, I can give you reference to service providers who I have found to be much of value to me. for your own purposes as well. So, okay. So with that, we'll go to the next slide. I think Babu has gone through my background, so I think I'll skip that for now. So first thing I'm going to do is that I want to give you a picture of what is the non-resident Indian statistics. Who are non-resident Indians? How many are there? Why should we care? And why does it matter? So first of all, based on data, there are over 3 crore NRIs. That is 30 million people who have a connection to India, either born in India or had some connection to India, who are now choosing to live outside of India. So 3 crore NRIs. The highest number of NRIs is in the United States. Almost 15% of the 3 crores, or 45 lakh people, or 4.5 million people live in the United States. And other countries like US, UAE, Malaysia, Saudi Arabia all contribute to the top. As you can see from the chart here, a lot of these countries have a very large number of NRIs residing there. The reason by putting this slide is to give you an idea that why is the Indian government after all the NRIs? Because there is a lot of opportunity and a lot of money sitting with this NRIs, which India wants to get back to the country. Okay, so total wealth of all this NRIs, you're talking about 30 million or 3 crore NRI, is 1 trillion US dollars. That's trillion with a T. That is 75 lakh crore is a total wealth that NRIs are holding. Just to put this in perspective, the Indian GDP in 2021-22 is 2.9 trillion. So NRIs just by themselves, even though they are a smaller number, 3 crores over 140 crore country, have almost 40% of the amount of wealth of Indian GDP. So now we can understand why everybody in India wants to go after the NRIs, because they want to get a piece of that action here in India. So Indian GDP is 2.9 trillion, US is 22 trillion, and the Indian NRIs are about a trillion. If you had to make Indian NRIs a country by themselves, they'll probably be in the top 20 countries in the world as well. Okay, that's to give you a context on why it's important. The second thing I want to show you is the inward remittances, the amount of money that Indians, NRIs who live outside, send money back to India on an annual basis. In 2011, it was 62.4 billion, and in 2022, it's expected to cross over 90 billion. Now, this is a big deal because means that money is coming into the country from overseas, which helps with our balance of payments. It also helps with our currency, foreign currency exchange, as well as a foreign currency holding in the country. So 90 billion is what people are sending. And in fact, India is the largest country for getting inward remittances from their own people outside the world. Mexico is number 2, India is number 1. Even China is not as big as India in terms of money coming into the country. And further information, the median family earnings of Indians in the United States. Now, a lot of my numbers are going to be oriented towards US because I have a lot of experience in the US. I have traveled to more than 88 countries in the world, but I haven't lived long enough to know enough about those countries. But wherever it is relevant, I will also touch upon the situation in other countries other than the US. But the median family earnings of Indians in US is $123,700, which is nearly twice the US average household income. So Indians in the US are considered very rich, or people with very high income. So even within the United States, the investment community is targeting Indians as investors because they know they have a lot of wealth, a lot of money to invest in various vehicles. So they are a constant target even for financial providers in the United States. And as you can tell, most Indians who go from India are college graduates. So 79% of Indians who are in the US are college graduates in comparison with the US nationwide average of 34%. So highly educated, highly motivated, high income, and high net wealth individuals. So Indians are a very clear target to attract both for United States as well as India in terms of taking a piece of the action. And if you further look at the number of millionaires, so less than 1% of the NRIs are dollar millionaires. You're talking about people who own more than $1 million in net asset value, right? So 2.5 lakh people in the world who are NRIs hold more than $1 million in net worth. Now, that's a lot of money. If you think about it, it's a lot of money. Out of that, majority of them, more than half of them live in the United States. The rest live in UK, etc. All that. The average wealth with an NRI millionaire, amongst those 2.5 lakh millionaires, the average wealth with NRI millionaire is $3 million. So you're talking about people, we're talking about people, the 2.5 lakh people who are dollar millionaires, the average is $3 million, which is close to 21 crore rupees in India. The median wealth of NRI is 1 billion, which says there is a very broad distribution. There are some NRI millionaires who are owning hundreds of millions of dollars, and the majority are owning close to $1 million. Nevertheless, $1 million itself is a very big number. So you want to see that the attraction for anyone to go after this particular community is because of the ability to for them to invest significant amounts of money. Okay. So with all that, I'm going to go on to the next part of the presentation, which is what is the NRI status? You know, people in India get very confused with the word NRI. They use it in very many different contexts interchangeably and often very wrongly as well. So I want to make it clear that there are three different kinds of things that can define an NRI. One is based on immigration. The other one is based on tax. The third is based on FEMA, or Foreign Exchange Management Act. The immigration status of people is decided based on whether you're a citizen or a PIO or OCI, and it's purely and only for determining arrival, departure, and stay possibilities in India and what activities can be performed in India. It has nothing to do with what tax you have to pay. It's nothing to do with what kind of accounts you can have here. So immigration is basically about entry, exit, and what kind of activities you can do in India. A tax residency, a different status. It's a taxpayer status. It is decided by a different department. The immigration status is decided by the home ministry. The tax residency is decided based on the finance ministry under the Central Board of Direct Taxation. So they have resident, ordinary resident but not ordinary resident, non-resident Indian, etc. All that various different statuses that NRI can hold based on certain criteria in terms of how many days they spend in India and what they do in India. And third one is the Foreign Exchange Management Act, FEMA. FEMA also decides whether a person is a resident or a non-resident based on a foreign transaction availability and also various other considerations. It's important to understand that people in India say anytime they know somebody who's living outside India, they're an NRI. Fine, that's a good answer. But then they combine people who are tax residents and immigration residents and foreign all into one bucket of NRIs, whereas these three statuses are very different. A particular person who's a whose immigration status is a PIO doesn't have to be a tax resident of non-resident. He could be resident of India also, depending upon a different criteria. So it's important to understand that these three things are very different things. So anytime you talk to an investment professional, please make sure the investment professional understands that they don't put you in one bucket based on the fact you live outside India. It's very important because your tax liability is decided based on the tax residency. It is not dependent upon your immigration. It is not dependent on FEMA. Similarly, what kind of accounts you hold in this country is completely independent of what kind of citizen you are or what kind of tax residency you have. So these three are very different things which everybody who's living outside India should completely understand, because people in India, particularly service providers, particularly banks, often confuse the hell out of you and end you in trouble. I have gone through this so many times that, to be perfectly honest, and no offense to finance professionals, I haven't seen any one person in India who can actually define these things properly. So it's very important, because at the end of the day, the responsibility is on you as an individual to make sure you're compliant with all the rules in this country. And these three things need to be very clearly known to you in terms of where you stand in terms of immigration status, tax residency, and foreign exchange management. So what kind of assets? I'm going to broadly classify the different NRI investment assets. I'm going to say it's on the one extreme, you have real estate, which is not very liquid, very high value, complex and risky. And then you have the traditional investments, the liquid investments, your fixed income instruments, as well as your stocks, mutual funds, and portfolio management systems. And then you have speculative investments like angel investment in crypto. I have, over the last 20 years, invested in all three categories. So I can talk about all of them, but today we are going to specifically target only the traditional investment, because the real estate and speculative have very different flavor, very many different kinds of criteria and objectives and the way they work. So I'm going to focus my attention mostly on the traditional investment, which is fixed income instruments, fixed deposits, cumulative deposits, post office schemes, etc., as well as stocks, mutual funds, and portfolio management systems. So going to the topic of today's discussion, what are the pros for an NRI investment in India? Why would someone want to invest in India as an NRI? The first one obviously is leverage the rapid economic growth in India. As you guys know, India is one of the fastest growing economies in the world today, even despite the COVID situation, as well as these geopolitical tensions in Russia and Ukraine, as well as other issues, inflation. India is still one of the fastest growing economy in the world. We are projected to grow by more than 6% in 2022. So clearly, people want to leverage the economic growth in India by investing in India. In terms of investment returns, I can tell from my own experience that the investment returns in India are much higher than anywhere in the world. To give you some kind of numbers, between 2000 and 2022, my investments in India, which is a mix of various fixed income instruments, mutual funds, etc., all that, has given me more than 15% return year on year. I don't think you get the same kind of returns anywhere in the world today. So it is clearly a destination where you can get much better investment returns because the interest rates in India are generally higher than anywhere in the world. Of course, lately the interest rates in other parts of the world has also gone very high because of inflation. But nevertheless, as a country over the last 20 years, you can see the return on investment for assets in India has been much better than anywhere in the world. Third one is asset diversification. Over the years, the Indian government has made it very easy for NRIs to invest in various different kinds of assets. You could invest in FD, stocks, mutual funds, PMS, non-convertible debentures, national pension schemes, portfolio investment schemes, tax-free bonds, government securities, sovereign gold bond. There's a whole lot of different instruments that Indian government has made available for NRIs to invest. Again, the the reason they're doing it is because they want to attract and get as much foreign exchange into India, so we can increase our foreign exchange reserve as well as have a better position for foreign exchange negotiations. So asset diversification is another reason why people would want to invest in India. The fourth one, this is what I thought when I first came to India, is that emotional connect. When I first came from US to India, I said, hey, when I'm in US, I realized at some point I want to go back to India. I want to have the ability to have emotional connect with India, and investment in India is a one good way of having an emotional connect. Whereas you feel that you're part of the system, you're part of the economy, you're part of contributing to the economy. So emotional connect is one reason why most NRIs would want to consider investing money in India for getting a good return. The other two items is plan for retirement in India, and a lot of NRIs who at least those I know who live in the US, many of them think about and aspire to retire in India. The reason is very simple. When you're working in the United States or any foreign country for that matter, during your working career, professional career, earning career, you have a lot of things to do there. Once you finish your work and you go for retirement, I can tell you from experience, life outside India is not that great. Now, I'm not trying to say that it's not great for everybody else, but in general, the kind of activities you can engage with post retirement is not as exciting in other parts of the world as it is in India. And so a lot of NRIs aspire to, and many of them do, retire in India. So if you want to do one of those kind of people who want to retire in India, you need to plan for retirement, which means you need to build a corpus of retirement in India. So that's one of the main motivations some people want to invest in India. And the last one is also very common: provide financial assistance to a family member. Maybe you're supporting your parents, you're supporting your siblings, you're supporting your in-laws, whatever the case might be. People want to be able to spend money to India so they can provide assistance to the family members. So they are interested in knowing how they can invest that money to provide the support to the family member. These are the various pros of investing in India. Now let's go to what are the cons for NRI investment in India. The first one I would say is information accuracy challenge. This is something I want to spend a little time on. As I told you guys, when I first moved back from the US to India, one of the things I found very difficult is to get answers to questions about what I am eligible for, what I am not eligible for. And as I said, majority of the people who approach me, particularly those bank employees, the people who are in the banks who are trying to secure their investments, often didn't have a very good idea about what you can and cannot do. So information accuracy is a very big problem, because at the end of the day, whatever action you take, you are still responsible for all your actions you take in this country, and you can't go back and blame that I got wrong information. I can tell you personally, there are at least 3 occasions where I had people give me information which was absolutely incorrect. And again, I don't mean to be very disrespectful for people in India, but people in India are very confident to give wrong information to you. Some of these bank managers, some of the mutual fund managers will come to you and talk as if they wrote the rule, and they'll give you exactly the opposite of what you're supposed to do. So one of the main things I would advise anyone who's looking at investing in India is please make sure that you do enough research on your own to ensure you have accurate information in terms of what you're eligible for, what you're not eligible for. It is often very difficult to get that because the rules themselves aren't very clear either. A lot of overlapping rules, a lot of confusing rules. So this, I would say, would be the single biggest challenge for anyone who want to consider investing in India. Things have become better over time. We have a lot more sources of information, and with the advent of internet, mobile, and the websites and etc. and apps, all that, we have a lot more information available today than what was available, let's say, 20 years ago when I first moved here. But nevertheless, the information is still not always clear. I have seen people make mistakes based on information they get from people, from various providers in India, and later on regret. So whenever you get information, please make sure you check it. Maybe look at multiple sources for information to ensure it is right before you dive into making a decision. Along with that, a related problem is finding a reliable investment advisor. I had gone through many of them in the last 20 years. It is not that the investment advisors are trying to do something deliberately wrong. Some of them are just not very knowledgeable. Because as I said, when they think about NRIs, they tend to think of us as one big bucket of people who are outside India. Fair enough. You're outside India is a fair enough assumption, but inside that we have very many categories based on your immigration status, based on your tax status, based on your FEMA status. So a lot of things that people assume not always true. So when you mention the word OCI, they immediately assume you're not in the country. So I'm a prime example. I'm an overseas citizen of India, but I'm very much a resident of India. But most people here would discount that and say, if you say you're an OCI, they automatically assume you're out of the country and start giving you information as if you're out of the country. So this is where you have to be careful. So having information accuracy from the right source and finding reliable investment advisor are the two big things I would say, which you want to do enough time on researching before you do any investments in India. Tax consideration is another huge activity. This I'm going to talk particularly in the context of US NRIs. There is something called FATCA, which is a foreign accounts and tax information for people, US citizens and US residents who have money outside the country. FATCA is a rule that came in 2008 post the financial crisis. What this basically means is that the US government wants to know about the investments that their citizens and their permanent residents are having outside the country. US wants to disincentivize US citizens and US residents from putting money outside the country. Often, as I told you earlier, the return on investment for money put in India is much higher than US. So a lot of NRIs were doing that. FATCA was a way for people, for the US government to have an idea about how much money is residing outside US from their citizens and residents. They also expect this to be completely you're supposed to do some regulatory compliance to make sure you inform the US government. For a long amount of time, a lot of people who are NRIs didn't disclose their assets in India, thinking that the US government would not know that. That is a very wrong assumption, and I want to make it very clear to all of you. Having non-tax non-compliance in the US is never a good thing. You may think that it is not going to be, they're not going to catch it because I'm a very small player. I have seen many cases where the US government gets some information, they do act on it. So FATCA is something that you have to be very careful. If you are going to be doing any kind of investment in India, whether it's a bank account or a mutual fund or a stock or what have you, you will all notice that there is a new section in the application form called FATCA where they actually ask you to disclose if you are a US person. A US person is defined as a US citizen or a US resident or someone who has tax liability in the US. They ask you to provide your social security number in that. So this is very important. People who think it is not required are making a mistake. So please be careful. This tax consideration of investments is very important. So FATCA and FBAR. FBAR is another declaration you have to make to the US government on an annual basis. The other thing I would talk about is the passive foreign investment company. This is a very big deal. Anyone who's a US citizen or a US resident who's investing in a mutual fund in India, please understand the US government will tax you at a very high rate of the return you make in a mutual fund in India. PFIC is a category that's created for basically to say that if you have money you're putting in a mutual fund in India, US government says we want to disincentivize you by taxing you a very high rate on your long-term and short-term capital gains. This is very important because a lot of tax advisors don't even know about this. PFIC is a very important consideration. Please check with your tax advisor if you do have mutual fund investments in India to make sure you are handling it properly. The fourth consideration is the currency exchange rate. This is also equally important because people, when they come and invest money in India, let's say people who are living in the US or anywhere else, invest in NRE accounts, non-resident external accounts, where the interest that comes out of the account is tax-free in India. Two problems people assume. Since it is tax-free in India, people automatically assume it is also tax-free in the US or anywhere else. That is not true. The interest income on NRE is only tax-free in India. It is not tax-free anywhere in the world. You are supposed to disclose that income to whichever country you are paying taxes because you are liable to pay tax on the income that is coming from NRE account. The second thing about NRE account relates to the currency exchange rate because when you invest money in an NRE account, your money in foreign currency, say it is dollars or pounds, gets converted into Indian rupees at that point in time, and the actual money stays in the NRE account in Indian rupees. Subsequently, let's say 3 years, 5 years, when the period matures, you want to take the money back. NRE accounts allows you to repatriate the money back into your home currency. But what they do at that point is they're going to reconvert that money, the principal plus the interest, back into your home currency based on the rate at that point in time. So if in between the time you made the investment in the NRE account to the time when you're trying to take the money out of the NRE account, if the currency rates have fallen, you could end up with a negative return. So let me give you an example. In 2003, I put some money in an NRE account when I came back to the US. At that time, the exchange rate was 45 rupees to a dollar. Later on, when I was taking the money out after 5 years, the exchange has slipped to more than 60 a dollar. Even though I got 12% NRE return and tax free in India, when I actually took the money back to the US at the end of the 5 years, I lost money because the exchange rate has eaten out. The exchange rate drop has eaten up most of my return, all my return, and some more. So be very careful. Exchange rate is something that is very critical in deciding if you want when and how you want to invest in India. As of today, for example, the exchange rate is standing around 77 rupees, and it is very difficult for anyone, including the Reserve Bank governors or the Feds, to directly know what the currency is going to do. But looking at the current situation in the last 6 months, there are a lot of headwinds against every currency in the world except the dollar. The reason being the very high inflation. Because of that, the interest rates are going up in various parts of the world, including the United States. There is geopolitical consideration, war going on, causing a lot of disruptions. There is supply chain issues. All these points out to only one thing: countries that rely on a lot of imports, which have a negative balance of trade. When your imports are higher than your exports, which have negative balance of trade, your currency is likely going to be depreciated in conditions like this. So currently, the conditions we are in right now, high inflation, high cost of commodities, high cost of oil, countries like India, which is importing more than exporting, we are likely to see a further depreciation of our currency over the foreseeable future. So if you want to invest money today, be careful, even if it is repatriable, if the currency were to move the direction of being depreciation, your return might get affected negatively. So this is very important to understand that currency exchange is something that could make a very big difference in your investments you're making. The last two steps are regulatory filing in India. As I said, a lot of compliances you have to do both in US as in India for all your investments here. Any income you make as a non-resident, any income you make as a non-resident in the foreign country, India doesn't have any problem taxing that. So if you're living in the US and you're earning money in the US through your job or profession, India, you don't have to pay any tax in India. However, even if you're living outside, if you're earning income in India, say it's rental income or investment income, you are very much liable to pay tax in India at the existing rates. People often assume that since I'm living overseas, I don't have to pay tax in India. That is not true. Any income derived from India or deemed to be derived in India is very much liable for taxation in India. So regulatory filing is very important. If you have income, please make sure you file your tax return in India at the right time. The last one is repatriation issues. Repatriation issues relate to how you take the money back from India back to the US. Repatriation issues are largely now solved. There are not much many issues now. Transferring money from US to India or India to US has become very standard. There are multiple ways of transferring money and retaining money, but even there, depending upon the amount of money you're transferring and what purpose you're transferring, you have to go through certain regulatory filings as well. There is a limit on how much money you can take from India to the US, and there is no limit on what you bring from US to India. So you have to be very careful about understanding those limitations before you decide to take any money from India back to the US. That is all I had for the presentation, Babu. I do have a bunch of slides after this in appendix. I left it because there are quite a lot of other information about taxation, immigration, and FEMA that people might find useful. So if people want to take a look at the presentation, they're welcome to see it. But I will stop my presentation right here and hand it back to you.
Super cool. Thank you, Mr. Vishwanathan. One question upfront is that if you were today where you were 20 years ago, knowing all that you know, I mean, your presentation was very lucid, very clear. I got, I'm just sharing it. I think I'm speaking for the rest of them, is that I get a feeling that it's a mixed bag out there. So
Yeah.
I want to ask of you is that if you were to kind of, if you were 20 years back today and knowing all you know today, will you still go ahead and invest in India? Is the first question. Second part of the question is you mentioned that over the last 20 years, you gained about 15% per annum return. Now, I assume that's a rupee denominated return. Now, if that were to be converted to dollar denominated return, will it still kind of have made sense? Is the question. So,
yeah, the first question is absolutely yes. As I said, a lot of different reasons why people invest in India. I gave 6 reasons to that. All 6 applies to me. I knew that the return on investment in rupee term is higher in India. Forgetting the currency exchange for a moment, currency exchange only affected in place if there was a significant drop over a period of time. If you look at our currency over the last 25 years, we were at 45 back in the early 2000. Now we are at 77. There were a few areas, few periods in that 23 years when the rupee actually slumped significantly in a short period of time. So within those borders, within those ranges of time, you enjoyed the return you want. Will I invest money 20 years ago? Absolutely yes. There is still a lot of opportunity to invest in India. A lot of places where there is still potential to get much better return than anywhere else in the world, whether it is mutual funds or stock. I will tell you that the equity markets in India are still very early stages. We have a very long way to go. There is a lot of potential in companies in India which remains to be unlocked. I cannot tell you enough how much potential exists with publicly traded companies in India. I'm not even talking about the private companies, purely only publicly listed companies. Tremendous amount of potential to be unlocked. Second one is amount of potential with the government entities. The government, as you know, over the last several years is doing a lot of these disinvestments. I think it's a good idea because there's amount of potential that can be unlocked from having these companies traded is tremendous. So yes, I would definitely invest. Currency exchange is a concern, absolutely a concern, and I think there's something that none of us can actually predict with great amount of certainty. But my point there was keep that in mind when you're evaluating alternate investment opportunities. If you have an opportunity to invest in say US or elsewhere in the world or India, keep that in mind that there is a factor that might reduce your amount of return that you are going to get vis-a-vis not having that currency exchange fluctuation. But potentially there, my advice if anyone asks me is that there is definitely a lot of upside in investment in India in terms of return, growth, diversification, etc. All that.
sure. So there are a few questions that are starting to come, but I'm going to ask a few questions which I've listed down. So
Sure.
before we start raising those questions,
Sure.
so it's far there, and there are 2 types of NRIs that I have encountered. One NRI, like you mentioned in your talk, is somebody who's kind of eventually planning to settle back in India. So it's far easier for them to jump and start investing and so on. But there are sets of investors who are going to continue to be there in the US. Either their children are now settled in the US, so they would like to continue to live there. Now, my argument for the second category, people who are staying back in the US, is Does it still make sense for them to invest in India? A. B is that if so, as an American citizen, they would have investments in certain buckets. In your reckoning, which of those buckets are worth for them to relook at in terms of liquidating, and which of those buckets should they be looking at in terms of investing in India?
Okay, super. I think the biggest one where I would say ask people to look at is if you're putting in fixed income instruments in the US. Fixed income instruments in the US traditionally have not been very attractive, whether it is deposits in banks or other companies, or whether it is even bonds for that matter. Now, bond market in US is a little bit strange, because bond market in US is quite strong. It's quite strong and quite mature, but the return on investment on bond market has traditionally been very low in the US, because US as a country has always been more taking further risk and doing more risk and doing much risky investments. So somebody who is going to be in the US, choose to stay in the US post retirement, want to make some return, I would advise them any fixed income instruments you have putting in the US, you should consider liquidating them and put that same fixed instruments in India. Yes, there is a risk of currency, absolutely no doubt about that. But my belief is over a longer period of time, the return you get on the fixed instruments in India is definitely better than fixed instruments in the US. Second thing I would say is that the latest category of investments, the speculative ones I talked about, whether it is angel investments, etc., that also opens up a very big potential for people. The startup market in India is very hot. The lots of people are doing very innovative things in India. So somebody has money who are they willing to take a big risk. I would say consider doing angel investing in India. Now I'll be very careful in making the recommendation. Angel investment is not for everybody. It's an extremely high risk, extremely high reward vehicle. But for those who understand angel investments, who are willing to take that risk, I would advise them, for people who are living in the US, who want to continue living in the US, consider doing angel investments in India because the opportunity is humongous. I have done angel investments both in the US as well as in India, and I can tell you with absolute conviction, my return on angel investment in India have far outbeaten the return in the US. So that is the power of the growth of the latest generation of entrepreneurs in India. So fixed instruments and speculative instruments, I would advise you put in India. The traditional stocks and mutual funds, etc., you could get similar returns in the US as well, because there are a lot of opportunities there to do. So there is no real, I wouldn't see any real reason for someone to liquidate a stock or a mutual fund in US just for the sake of putting in India, because you're not going to see, in my opinion, not very, very big returns there at that point.
The last question from my end, Mr. Vishwanathan. So, if you are advising somebody, and for the lack of any further information, uh, if you wanted them to put a certain number of their money, and you mentioned in your slide that one of the pros of investing in India would be a diversification. Instead of having all your money in US securities, a certain percentage you would want people to diversify into India. In your reckoning, having been through the journey as well, uh, if you are going to eventually settle down into India, what is that number? And if you are going to be a person who's going to always be in the US, what will be that percentage that you would want them to consider investing in India?
Okay, good question. It's a very difficult question to answer because it depends upon individual person's risk appetite, etc. But I would say that if you have made a decision to retire back in India, then your expenses are all going to be in rupees eventually in the time. So I would say that in those kind of situations, I would recommend more than 75% of your portfolio being invested in India. The reason I'm saying you want to still keep money in the US is because people who are NRIs or citizens who lived overseas for a long time often want to go back to the US or wherever they are from, either for vacation or visiting friends, relatives, family, etc. All that. And in some cases, they may even want to go back eventually if things don't work out. So there is definitely a need to keep certain money in the US. But if your plan is to retire in India, then I would say park majority of the money here and park the money in such a way that you can keep investing continuously. Don't bring all your money in one fine morning and try to make money here, because markets can be in a different position, the currency in a different position. So if you had made a decision to retire in India, start early as possible. Plan a certain amount of money to be moved from the US to India, and look at various asset classes in India to diversify to put that money for retirement as well. Now, if people are going to live in the US and continue to live in the US, should they even care to put money in India? That's a good question. If you're going to choose to live in US, then you may not have much expense. But even as similar to people who come from India, retire, from the US, retire in India, people who are going to live in the US also may want to come to India periodically to visit their friends, family, etc. All that. So there is a need for them to have a certain amount of money here, but that may not be a very big amount of money. So I don't see very many US people who want to continue to live in the US putting much money here, and because it really doesn't make much financial sense to do that. If return on investment is a big thing for you and you're willing to take the accept the currency risk, then yeah, there's a possibility. The one that I would encourage people who are choosing to go to stay in the US to put in India is the startup investments. That particular category of investment is still a very big possibility for growth in India. So if you're going to decide that you're going to be playing in that particular space, the amount of money you want to allocate from your overall portfolio, you may want to consider allocating a significant portion of that piece into startups in India.
Super cool, sir. Super cool. Thank
Yeah.
you. So
Yes.
I'm going to start reading the questions that have started coming. So
Okay.
Ajay Sridhar has this question. Is the interest income from the NRO account taxable in the US? Is the
Yes.
question.
Absolutely, yes. In NRO, income is taxable both in India and in the US. So if you were to have an NRO account, NRO fixed deposit account in India, whatever interest you gain, first of all, is taxable in India. Now, that same amount of money, if you are a US citizen or a US resident, you are required by US laws to report that income in the US also. But there is also something called double taxation avoidance agreement between the US and India. It's a bilateral agreement whereby the US government and Indian government have agreed that they won't tax the same income twice. So to that effect, what they have done is that if you are investing in an NRO account that generates return in India, and if you had paid tax on that interest in India, then you still have to disclose that income in the US. But against that income, you can take what is called a foreign tax credit. The calculation of the foreign tax credit is not that straightforward. See, it's not like you pay 100 rupees in tax in India, you get 100 rupees off in the US. It doesn't work that simple way. You have to go through a certain calculation to decide how much credits you can take. But NRO definitely is taxable in India as well as in the US. NRE is not taxable in India, but taxable in the US.
Super cool. Super cool. So the main substance is that we have a bilateral double taxation avoidance treaty between India. So the same amount will not get taxed in the other country. However, like you said, it's not apple to apple conversion. So
Correct.
there will be some changes in that.
It works both ways. So let me give my example. I have investments in the US. I also have investments in India. My investments in the US, for example, my mutual funds, my stocks in the US, I pay tax on those income in the US first. And against that, I report that income in India because as a Indian tax resident, I had to disclose global income in India as well. So I disclose that US income in India, but I don't pay tax on income because I have what is called a tax offset in India. India calls it a tax offset. US calls it tax credit. Here the tax offset. That calculation of tax of it is also not an apples to apples. There is a specific calculation you have to do in your Indian tax return to show that you have included all the income in the Indian tax return, including the US income. And you also have to show how much tax you paid on that income in the United States. And using that, you create a rebate calculation which tells you how much less you have to pay. Net, what I can tell Babu is that I end up paying more than 100% tax. So if I had to pay 20 rupees on a 100 rupee income in India, I end up paying at least a little bit more than that in the US. So my net tax is more than just one country, but less than twice. So
Okay.
that is something you should understand. It's not like you had a tax free another country. The calculations, the way they go about doing, you end up paying the full tax in the country where you take the income initially, but you also may pay a little bit in the other country as well because of the way the calculations work. Actually,
Good one. Good one.
yeah,
Absolutely.
yeah.
Tej has this question. How can one build a retirement fund in India being in the US? What will be the best approach to invest and trade in Indian stock market, avoiding the tax complications?
avoiding tax complication. I don't think you can avoid tax complications. The best way to invest in US Indian stock markets, if you are an active investor where you have the time to analyze and understand the companies, how they do, then I would definitely advise you to open a demat account with one of the NRI demat account. So there is specific demat accounts for NRIs which you can open, and through that demat account you can do trades of India listed securities in both the BSE and the NSE. But those trades and the corresponding capital gains and or dividends will be reported to the Indian tax authorities. By law, these companies where you are holding stocks have to report the income as well as your capital gains to the tax authorities. So you'll have to disclose that in a tax return, even if you're living in the US. As I said earlier, the fact that you're living in the US or elsewhere, and if you have income in India, you definitely are liable for tax on the income in India. India doesn't care where you live. If the income is derived in India, you pay tax in India. So building a retirement corpus for living in India is very possible. A lot of people do that. You should think about the amount of money you want to have in India, and you also want to think about the kind of risk you want to take investing in India. But yeah, there is a lot of people doing that, and I'm happy to give you further perspectives because I'm working on a retirement webinar specifically targeted towards NRIs who want to choose to live in US or India and say what are the consequences of doing both. So I'm happy to give you further information on that. But yeah, tax is definitely due on that.
Thanks, Vish. Can I ask a further question on this?
Yes, please. Yes, please.
Yeah. So thing is actually, the demat account, if you open, but it should be on the NRE account, right? That is a better approach, right? NRE.
It doesn't matter. I mean, it could be NRE, or it depends on what you want to do. If you want to have that money to be taken back to the US, if you want to repatriate the money, then you definitely have to use the NRE route. But if you don't want to take the money, if you want to keep the money in India, then you can do it in NRO account also.
Okay. So the question further on that, right? As you said earlier, mutual funds or ETFs, if you invest in any one of those things, actually, there will be a lot of taxation issues in the US. So to avoid those complications, because most of the people, they're discouraging if we are going in that way, right? So they say, oh, there are a lot many laws, so it will be very difficult to convince US government, right? Taxation. So what is the best way? So I want to invest in the ETF. Even ETFs also the same complex, like mutual funds.
I think anywhere, whenever you're in, so the way the US government defines PFIC, a passive foreign investment company, is that if you're putting money into another organization whose primary purpose is to reinvest the money, then it's considered a PFIC. So in other words, if I want to buy into a mutual fund, I am putting money into a mutual fund company. Mutual fund company is actually taking your money and investing in some other place. In other words, their primary business is investment. If you were to put money in an insurance, for example, then that is not considered as PFIC. If you put money in a ULIP, it is not PFIC. So there are ways we can work around it. So for example, if you're putting in a PMS, a portfolio management system where your money is directly invested in the equity markets, the way PMSs work is that you have a PMS advisor who takes your money and creates a custom portfolio of stocks to purchase with your money. Now here, the PMS advisor is not holding on to your money. He's basically facilitating your money invested directly into the stock. So PMS is not considered PFIC. Mutual fund is considered PFIC. So you could go and put money in PMSs. The only challenge with PMS is that often they have very high minimum investment. Usually it is 25 lakhs or 50 lakhs. And there are also some additional management fee in that. So if you want to avoid the PFIC taxation that comes with mutual funds, you could consider doing PMS, where you don't have to do the PFIC problem in the US, but you may have to have very high initial investment there.
Instead of that, directly, if I want to actively manage the accounts, like I will invest.
Yes.
I'll go by might be suppose Bank Nifty or something like that. Some ETFs I can directly buy.
Yes.
I can hold. I can manage. So will there be any complications?
No, ETF, no problem. If you're going to hold stocks directly yourself through an NRI demat account, no problem. You can definitely do that. You just report the income both in India as well as in the US. It is not considered PFIC.
Okay. And apart from this, suppose if I open any accounts, on my father's name, right, under my father's name or something like that, and I want to grow that account, and they can pass it to the next generations.
Yep.
Like, so is it possible? Like even after them also, can we manage those accounts and pass it to the next generation? Can we build like that?
It is possible. See, there are certain considerations in the terms of inheritance. When it comes to inheritance, what you're doing is that you are actually building a corpus for your father who lives in the US in order for you to use the money after he goes away, right? That's what you're trying to do.
Correct.
You have to be careful. You have to be careful because if you're going to invest and create a corpus in your relative's name, that person becomes liable for tax in India. Now, if that person were to write a will or some kind of notice saying that after my time the money goes to XYZ person, that money can be given to the person. If that person happens to be not in India, then you have to go through certain procedures. It is not easy for someone because you living in the US, you're not supposed to hold a savings account in India. So if you're going to create a savings account for your father and you put money in your father's name, and let's say tomorrow he's no more, you can't operate the account anymore because you're not a resident of India. So you'll have to convert that account into a non-resident account. At that point, you have to show that the origin of the money is from your father. The tax people, if they really want to be diligent, can question you on the origin of your father's money also. Right? In other words, tax people are actively trying to disincentivize you from doing what you're trying to do. But for them, if you create the account in your father's name and your father writes a will and the money comes to you, you can do the conversion from resident to non-resident and still enjoy the money. It's perfectly possible. But be prepared in case the tax people want to ask questions. What is the source of money for your father's account in the first place? They have the right to ask that question.
Okay, but still I don't want to take it out. So when I retire there, I want to use this money. Okay?
Yes, you can definitely use it. You can if you're going to use it here, once you become a resident, you can absolutely use that money without any problem.
And I can pass the same thing to next generation as
Absolutely possible. Absolutely.
Thanks, Vish. I would like to talk to you on further on this. Might be not now, okay, sure. Because I'm obstructing others. So, is there any better way we can reach you?
You can reach out to me through WhatsApp, or you can take my information from Babu and reach out, and we can get a space that way. Not a problem.
I will send you a mail with Vish's contact.
Yeah, no problem.
Thanks a lot, Babu. I appreciate it. Thanks a lot. Thanks, Vish.
Yeah. Other questions?
Yeah, Ajay Sridhar has this question. What kind of tax implications would one face while building retirement portfolio in India?
What kind of tax consequences you face? Whether it's a retirement portfolio or another portfolio, any portfolio maintained in India, if you're maintaining fixed income instruments, then your return on this is very taxable in India. If you're holding on to equity instruments, then you have to pay tax on dividend and capital gains. So in terms of the tax implication, there is no difference between whether you're a retirement corpus or not retirement corpus. Where it makes the difference is when you turn a certain age, then the tax structure in India is such that certain kinds of residents pay a different type of tax compared to other residents. So it's not a function of what the account is, it's a function of what your age group is that decides what kind of tax you pay. Right? So if you want to build a retirement corpus, be aware that any income that comes out of the retirement corpus will be taxable in India and has to be reported as income elsewhere also.
So Vish, just to add to this, since the question is about retirement, I just want to kind of add to this point, saying that Ajay, if you were to start a portfolio, and let's say you are at an age where you're starting to build a portfolio over the next 10 or 15 years, and in those 10 or 15 years, you're not looking at any income from that portfolio, and let's say that portfolio is going to continue to grow. In the interim period, there may not be any tax liability.
Correct.
Even though if you don't draw any dividend or you don't take any corpus out, you don't have any tax implications. So assuming that you're creating a corpus over a 10 or a 15-year period, at the end of 15th year, if you want to kind of pull out something on a month-on-month or a year-on-year basis, return out of that corpus, definitely there will be tax implication at that point in time. So
Correct.
Just to further add to what Vish said, is the tax implication in India is more about when you access the money back, not when you're investing much.
Correct.
I hope that
it's important to understand the PFIC clause in the US also taxes on unrealized income as well. Unlike here in India, we don't tax on unrealized income for equities at all. In India, for fixed instruments like a fixed deposit, you do pay tax on an income even if you haven't actually taken the money. Whereas with equity markets and securities in India, you don't pay any tax unless you actually enjoy the realized gain. In terms of investments in mutual funds in India, the US government wants you to pay tax even on the unrealized gains. So that is where you have to be very careful to make sure that you don't end up paying tax on gains that you don't actually have.
Okay. Thank you.
Yeah. I know it sounds a little confusing, guys, but I tell you, once you get into that, you will know about all these things, and it is perfectly possible to construct a reasonably tax efficient, I don't want to use the tax avoidance, tax efficient portfolio in India, which can actually help you taxation both in India as well as the US. You can do that. I have gone through that pain to identify that magic, and it is definitely possible. Definitely possible.
So, Vish, we have a bunch of questions. I'm going to go a little fast. Venkat has this question. For managing exchange rate risk, is there any possibility of hedging the exchange rate with the banks for the NRE account, such that we can transfer at the agreed exchange rates? Does that even make sense?
There is one called the forward contracts, currency forward contracts. A lot of banks offer the currency forward contracts where you can put money right now and the bank will essentially guarantee you a certain currency exchange and a certain return. And if, God forbid, the exchange falls, the bank is supposed to compensate you for that. So there is something called forward contracts. You can certainly try forward contracts with all the banks. The other thing is to do currency trading, which I would not advise anyone to do unless you are really, really understanding that market. Currency trading is a very complex concept where you could work on what is called the difference between the exchange rates in multiple countries and use that as a basis for making money. That is not simple, but this forward contracts is something that people can try. I have done this at ICICI Bank, and in particular case, ICICI Bank ended up losing money because the currency did fall. So they end up paying me a lot more money than what I needed to get because the currency fell. So they didn't make the better end of the stick. But the forward contracts are not for a very big amount of money. It's also not for very long duration. It's normally short duration contracts that you have to sign with them. But yes, that definitely hedging is possible.
Priya has this question, which is more non-financial. She says, when we think of retiring in India with our kids in the US, how would you consider when you get really old and unable to travel? Then would we end up seeing kids a lot less in our final years? How did you or others in this situation think? This is certainly not a financial question, Vish. It's right up your alley, though, but go ahead.
No, I think that's an interesting question. In fact, there is a lot of work going on in India to address this particular question. I think the best way to answer the question is to have a separate session, because I do know this particular issue very well. My kids, for example, are living in the US now, and so I obviously had at some point trying to figure out what I do with them. Notwithstanding the fact I want to be a completely independent individual, not have to rely on anybody else. I don't decide my destiny only on my own self. So at some point, I may need help from my kids as well. This is definitely not a financial question, but I do have some perspectives and thoughts on that. I'm perfectly happy to sit down and discuss with whoever wants to do about what I have observed and what solutions I have in mind to address this particular issue going forward. There are a lot of organizations in India that are starting a business to address this specific need of providing services to NRIs who retire in India, to get access to all the things that they need to have without having to rely on their kids in the US. So I can certainly help you. Now, the emotional part of it, I cannot help you. That's a different issue. But anything that is financial, non-financial, or practical or feasible things, I can certainly talk about. But yes, certainly happy to talk about that and happy to discuss what we can do there.
Thank you, Vish. Friends, it's about an hour and 10 minutes since we started talking. I'm sure that something like this can go on for a longer period of time. Of course, if there are any more questions, very, very happy to kind of take them as well as we go. Which I had one question which I kind of wanted is that is the government policy, and one of the difficulties that most NRIs seem to face or think about when they come about investing in India is that are the policies that the government makes friendly towards investors overseas, especially NRIs, or is there more that can be done there? Because people worry, like you rightly said, there are There are a bunch of regulation on the US side. There are a bunch of regulations on the India side. A lot of confusions in people's mind, and when you have a confusion, you just want to kind of stay put at where you are and just not do anything about it. Right? So, is there, because of all this bureaucracy, is there a problem that people face? And how would you recommend they overcome this?
So one of the first things I would say is that the facilities that the Indian government has offered for NRIs is far better now than what it was 20 years ago. Many things that are very hard to do in the past have become much more easier. Still, there are places where we don't have the level of flexibility we want. So for example, if you're an NRI and you want to trade using stock in the equity markets in this country, you have to buy and hold the stocks. You can't do what people in India do. In other words, you have to open a PIS account and you have to trade through the PIS account, where every time you have to trade, you have to sell the existing stock, get the money into the account, reinvest in another stock. Those kind of complications are still there for NRIs, which residents don't have to face. So yes, there are places the government can make it a little bit more easier than what they are right now, but they have done a lot of work in making it easier than what it used to be, say 20 years ago. The second thing I would say is that the confusion between what identity I want to have in this country. Do I need an Aadhaar? Do I need a PAN card? This is a constant topic. So the Supreme Court of the country has made it crystal clear that Aadhaar is not necessary or not compulsory for anyone to have, except if you're going to be doing any government related transactions. Despite that, if you go to any bank or any mutual fund company, the first question they ask, do you have an Aadhaar? Now, people don't understand. If you're living overseas, you cannot have an Aadhaar. Aadhaar is only for residents of India. So for a bank to ask an NRI if Aadhaar is a very foolish question to start with, but they'll ask it very clearly. So if those kind of confusion on what paperwork you need to have, what documents you have to have, if the government can come out on a clean paper, that will help a lot of people come out of the confusion. Having said that, a PAN card is something that everyone needs to have. Whether you live in India, whether you live overseas, whether you're a US citizen, whether you're an Indian citizen, doesn't matter. If you are going to have any income in India, you need to have a PAN card. Because without a PAN card, you can't file taxes. So you need to have a PAN card no matter who you are. That's very clear. Now, in people's mind, a lot of people think PAN is not essential, not necessary. That is not true. PAN is essential. Aadhaar is not necessary, although banks ask for it. So these kinds of what I call documentation related, regulation related things, the government can come out with some clarity that will be very helpful. Right now, it is subject to interpretation, and each person interprets it differently. But I have done enough research on this topic to tell what is absolutely required, not required, particularly for US citizens and particularly for US citizen OCIs who live in India. See, this category of US citizen living in India as a resident is a very small population. We are not understood by anybody in the world. so this category is a little bit more specific, but in general, NRIs, there could be some more things that the government can do to make it easy. Now, the US government is going the other direction. They're trying to stop anyone, a US citizen resident, in putting money outside. They don't want the money to leave their shores. So they're making it only harder. Recent example, IRDA, the Insurance and Regulatory Authority of India, has made a rule now saying that if you are a US citizen living in India or a green card holder living in India, if you want to go to the US and buy travel insurance, previously you can buy travel insurance up to 1 year. Now they have said that IRDA has put a rule saying that if you are a US citizen or a US resident, you cannot get more than 90 days of travel insurance, because they don't want the US insurance companies to lose out on the business of providing you insurance. So US government has made the IRDA pass a rule to prohibit selling travel insurance to US citizens. An example of what US is doing versus what India is doing, right? So you have to understand all these things.
This is interesting. How governments are trying to influence the way we kind of interact and interface.
Exactly.
Always, more insights on these kind of things will help us sharpen our knowledge. I think, unfortunately, we're completely out of time. We've kind of more than 1 hour and 15 minutes, I think, friends. I want to first, on behalf of all of us, place a thank you to Mr. Vishnu Vishwanathan for kind of sparing time and being with us right through this and sharing his journey of how he is kind of derived the best of both worlds, best of the Americas and best of the Indian story and how he has been able to navigate. Of course, it has been through its challenges, but I am sure that it's not something kind of impossible. So, thank you so much, Mr. Vish, for sparing the evening or morning in the US. We would kind of be sending this recording of this as well. Finsherpa is one more organization that provides India investing opportunities, which is the company that is organizing this show. So do reach out. We will send you a mail with the recording links. If you think there is some role that you would like to kind of start discussing with, we'd be very happy to kind of discuss further as well. Thank you so much on behalf of all my colleagues and all of us here for sparing time and being here, and look forward to catching up once again. Have a lovely weekend. Thank you so much.
Any questions anybody has that they couldn't ask in this session? Babu, you can try to get the questions from people, and maybe we can provide them the responses in a timely fashion. So you could, since you know the access to all the people who are joined the call, you could probably.
Vish, can you hear me?
Yes, I can.
Yes.
I wish there's something out of the way, and I'm not used this Demat account so far. In fact, I'm not done much of share trading. I just discovered one of my old shares has been, which was in the paper form, has been now compliant on the Demat account. But they are cautioning me regarding the DPs. What is DP they mentioned?
DP.
Yeah.
Babu,
So,
you want to?
yeah. So DP
it's in the local. It's in India. I'm not an NRI. You know me.
Okay. DP like in.
See, this particular share is with NSDL.
Okay. So if you are local, Mr. Kannan, you can take it offline because I can help you once I have a look at that statement. I think it will be easier to kind of share this. DP is nothing but the service provider. If you have that Demat account with Citibank, then the DP will be Citibank DP. If you have an integrated finance, it will be integrated. It will be.
I have one with HDFC.
I'd say HDFC DP, yeah.
The DP will be HDFC. HDFC is the authorized DP for that. So I'm sure we can kind of work to help you with that.
And then I can connect you to Babu, and you can certainly, Babu can help you with that actually.
Okay. So I think I'll have to contact my bank and ask my relationship manager to help me in this regard.
Yeah, absolutely. Yeah. Super. So,
thank you so much, sir.
Yep. Thanks, Babu, for the opportunity, and thank you guys for spending the time. And anytime you have any questions, please reach out. Happy to help.
Thank you, Mr. Vish. Thank you.
Yeah. Bye.
Thank you, friends. Have a lovely weekend.
Bye.